Okay, everybody, hello and welcome. I'm just going to wait a moment or so for the last of our attendees to join the room, and then I'll be giving you all a quick intro into the event. So bear with us just a moment or so, and then I will begin. Let's get all set here, and it looks like most of us are in the room now. So yes, hi everybody, and welcome to today's session, Shape the Debate, part of PA Online 2021. And my name is Benjamin Verity, and I'm going to be your host for the next hour or so. Now, in this live session today, you can put your questions to our two resident experts that you can see on screen right now. We've got Val Stewart and Tony Austin. And actually, you can interact with the three of us live as the questions are being delivered. So today's live Q&A is due to last around an hour. And we're going to be covering both your pre-submitted questions and the live questions you send through to us on the chat panel. So talking of the chat panel, if you look to the right-hand side of your screen there, that's where you'll find that chat function. Now, all questions are submitted in private, so please do ask away. You know, no question is a silly question. And if you're watching a replay of the live event, then the chat function will be disabled, but you can just reach out to Professional Accountancy for some further information there. So then, on to the introductions. I should probably start with myself. My name is Benjamin Verity, and I work at Xero, if you couldn't tell from the t-shirt. And so I'm an education specialist here, and a big part of my role is getting to work with accountants and bookkeepers like yourselves to help you and your clients make the most out of our platform. And we do that by connecting you to technology that's going to help you take time back in your day to spend where it really matters. But I'm really happy to say that today I am joined by two experts who are going to be answering all of your questions live. And the first is actually Val Stewart. So Val, for over 20 years, has worked with accountancy practices, helping them to develop their business and remain compliant. She is actually the author and co-author of a number of technical guides and work programs that you may have already seen. So including the CCH Industry Audit and Accountancy Guide on Clubs and Associations. There's the Practice Society Anti-Money Laundering Procedures and Training Manual, and the ACCA Audit Programs and Engagement Letters. Now, Val specializes in the not-for-profit sector, lecturing and advising, management skills and assurance services. Now, you may have actually seen that Val has already had a session of her own in PA Online 2021, and that was the 5 topical areas when dealing with small companies. So do definitely check that one out if you haven't seen it already. And then we also have in the red corner, Tony Austin joining us today. And Tony has actually been a chartered accountant and tax specialist for over 30 years, of which nearly 20 of those were as a tax partner with BDO and Mazars. Now, he advises owner-managed businesses, both large and small, on all aspects of direct taxation and tax planning, affecting them and the people that own them. So this has involved him in tax planning for businesses coming to the UK, foreign business owners setting up here, group structuring, transfer pricing, and employment tax matters and partnerships. Tony has also written himself for LexisNexis and lectured on a variety of tax topics. And much like Val, Tony has also had a few sessions in PA Online 2021 that are definitely worth checking out. We've got the direct tax update, including the budget for 2021, and taxation of business profits, a guide for the non-specialist. So 2 really cool sessions there that I would definitely recommend checking out if you haven't already seen them. And so that is my big introduction. I'm sure we're already tired of hearing my voice. So just to say a quick hello and a massive thank you to Val and Tony. I'm sure we're all really happy to have you on the line today. And just again, to all of our attendees, feel free to start asking your questions in the chat panel. We've already had quite a few coming through. And so without any further ado, I'm going to jump straight in to our first question that we've had submitted today. And this one, actually, Val, is aimed at yourself.
Thank you.
So this one here, this is a question asking, do I write back depreciation charged in previous periods when I think that the residual value of freehold property is in excess of cost?
Okay, thank you. I think that that's something that sometimes people do get really confused with. I'll go back in terms of looking at what it is that we have within FRS 102 now, because previously under FRS 15, when we were under old GAAP, when we were looking at the residual value of a property, so we were determining what the depreciable amount would be, looking at the cost or the valuation less the residual value, we had to consider that at historic cost. So we were looking at it in the case of what it would have been worth when we bought the property. So if we bought a property for £100,000, we would look and we'd say, okay, if we reckon that we're going to be depreciating this over 50 years, what would a similar property in a similar location that was 50 years older, how much would we have to pay for that one? And that's what gave us our residual value. Under FRS 102, what's happened there is that the residual value is what it's worth now. So without you doing a revaluation, it's about saying how much would we actually get for it if we sold it now. So in many cases, that could be, if you're expecting the, if you're keeping the asset in a good condition, you would expect that to be more than you'd paid for it potentially. So what you do is that if you're looking at it and you're saying that our policy is to depreciate the cost or valuation less the estimated residual value over the useful economic life, which then gives us what through. If you do that now and you're looking at that now in terms of what it is, and you've got a property that has been depreciated, so that £100,000 maybe now its carrying amount in the accounts is £80,000, you don't reverse it, because what we're doing is we're looking at a change in an accounting estimate rather than a change in policy. Our policy has always been to depreciate, but now what we're looking at is that when we're looking at the figures that are there, our estimation of what the depreciation should be has changed. If we look to reverse the depreciation, then we're going into revaluing. So the answer to that easily is no. Yeah. But the explanation is why it's no.
Perfect. Thank you so much. Yeah, that's really clear, actually. Thank you for that explanation.
Cool.
And Val, actually, I'm going to stick with you for our next question. We've got another one come through that's just asking, should software development costs be treated as intangible or tangible?
Okay, that one actually it's another one that's an interesting one. And there is no strict rule in terms of what it is that you do, but the common thought process in terms of how you might treat them is that if you've actually developed software yourself, which is, sort of maybe some database software or something like that, then that would usually, but not necessarily have to, be treated as being an intangible asset. But where what you've done is you've bought something like a Windows operating system, which is needed in order for you to operate the computer software the computer hardware that you've got, then that would normally be included within your tangible fixed assets. In both cases, they have to be either amortized or depreciated. But really what you should have is a consistent policy in terms of the way that you're doing it. So I wouldn't normally expect to see things like the purchase of an operating system. I wouldn't normally expect to see those being treated as an intangible asset, but the development of something that you're using within the business, sort of that could be usable on anything, and that you don't need that in order for the hardware to work, you can treat as an intangible asset.
Awesome. Brilliant. Hey, thank you so much for that one. I think I might actually take the next question that's come through. And we've had somebody come through, and I guess they've seen my Xero t-shirt, and so that's why they're asking. But they've said, I've got a lot of my clients that are using spreadsheets, and I'm thinking of transitioning some of them onto software, but Xero does seem quite pricey. Does Xero have any products that suit smaller internal clients? So yeah, great question. More than happy to answer that. So when it comes to Xero pricing, we have our 3 standard business editions, and that's Starter, Standard, and Premium. And I imagine that's what you've looked at so far. And so I understand that, with subscription costs maybe around the £20 a month mark for the standard, maybe that's looking a bit much for those smaller clients. But the good news is that actually for accountants and bookkeepers like yourselves on the line, if you decide to become a part of the Xero Partner Program, which is open to all accountants and bookkeepers, you do then get access to some other partner pricing editions. And so we have both the Xero Ledger edition which is only £2 a month, and that is perfect for clients who just need annual accounts preparation but maybe no VAT reporting. And typically that's something that you manage internally, and your clients can just have read-only access to it. So that's only £2 a month there. And we do also in the UK have some cashbook editions, which start at £5 a month. And the cashbook editions are great for clients who don't 50,270 from the 6th of April. But does that apply to the tax on child benefits, the HICBC?
Yeah, well, the answer to that, simple answer to that is no, it doesn't. The HICBC rate limit rather is income of £50,000. Now that was certainly last year the same limit at which point the higher rate tax came in. So if you're basically if you weren't a higher rate taxpayer, you didn't have a problem with claiming child benefit. Because the limit, everything's been frozen apart from a small increase in the personal allowance, you've now got basic rate taxpayers who could be hit with a child benefit charge. So if the person receiving child benefit payments or their partner has an income, taxable income above £50,000, then they will start to have to pay back some of their child benefit. And they pay back £1 for every £100 of income over 50,000. By the time you've got to an income of £60,000, you're paying it all back. So it's maybe best not to receive payments. But I would stress, however, that people entitled to child benefit should claim it, but not and then refuse payments, because by claiming it, you get a national insurance credit.
Of course.
Which unless you're working, you will need your pension. And you don't have to receive payments in order to claim the child benefit. But yeah, do watch if your income has gone up a bit, and you think, I'm still a basic rate taxpayer. Well, you maybe have to pay back some of your child benefit.
That's brilliant. Some really good advice there. Thank you, Tony. Okay, and so the next question I can see coming through is actually asking, and this is for yourself, Val. They're asking, how long do I need to consider when I'm looking at going concern?
Okay, so whether you're doing an audit or whether you're not doing an audit, when you're producing a set of accounts that are showing that that the business is a going concern, then the directors need to consider a period of 12 months after the date of approval of the financial statements. So the issue that you have maybe at the moment is that because we're still just about within the period where you'll have some sets of accounts maybe where they've been given the 3 months automatic extension by Companies House. And because some businesses, either because they've been interrupted by coronavirus or because they want to wait as long as possible so that they can have a better idea of the impact that it's going to have had on the business. So if you're now at the end of this week putting in a set of accounts for an April 2020 year end, then what you're doing is you're actually having to consider a period of 2 years from the year end when you're looking at going concern. So you'll be looking at what's happened within the next trading year, but you've also got to then look forward in terms of what's happening within the next 12-month period. And if you're doing audits, obviously there is a lot more work that you need to do on them. But I think that you also need to be very, very careful, because if you're doing just straightforward FRS 1021A accounts, or if you're doing FRS 105 accounts and you're issuing an accountant certificate with those, we have a professional responsibility to make sure that our name isn't associated with something that could be deemed to be misleading. So, you know, even you can't get out of it, even where there's no where there's no audit requirement in terms of what it is that you're doing. And the thing that I'd also add from my perspective, or from my point of view here, is that I know that for a lot of businesses you deal with, they might not do cash flow forecasts and you know, sort of and budgets and all the rest of the bits and pieces, but now in this current period, it's completely different from what it's been in the past. So whereas it might have been enough in the past for you to look at a company and to say, well, have they continued to trade profitably? Has anything changed? So that would give you some comfort as to whether you felt that it was reasonable for the accounts to be drawn up on a going concern basis. Now, nobody knows. A business that could have been very successful in March 2020 may now be on its uppers just purely because of the impact that coronavirus has had on them. So I don't think you can just look at what's happened since the previous year end when you're considering what it's going to be. You've got to actually talk to them about what's going to happen going forward, and if there's been a big impact on the business, then you need to be thinking about, what's going to happen when the coronavirus job retention scheme drops off, when they have to start repaying their bounce back loans, if they've taken advantage of some of the VAT deferrals and, and the personal tax deferrals, or they've got time to pay with HMRC, are they going to just be suddenly hitting that wall where they've got so much that they've got to repay that they're going to struggle? So,
definitely. That's really good advice. And, especially in the context of the last kind of 16 months, I think, really good points there. We've got to take that into account. Val, I'm actually going to ask you the next one as well. We've been asked by an attendee, they've said, my company trades in the local area, so why would I need to consider Brexit?
Yeah, I think that's quite a good question in terms of the stuff that's there, but I think that the issue with this is that although maybe you would consider that the businesses where they are trading with the EU or outside of the UK, that they might feel that the impact on their business is going to be higher. But even with the business where they're trading with UK-based companies, if there's a possibility that there could be an interruption in the supply chain, or alternatively, if there's going to be price increases, which everybody is touting is likely to happen within some sectors as a result of it, I think that it's naive of a business to assume that Brexit won't have any impact. It might not be as significant an impact. And so, again, I think that when you're talking to your clients, then you should be asking them if they've seen any changes, if there's anything there, if there's any little bits and pieces that they're doing that will actually mean that Brexit could have an impact on them.
Mm-hmm. Perfect. Hey, thank you for that one. Tony, I think the next question would be perfect for you. We've been asked by an attendee who has said, I have a client company for which, as a matter of policy, all expenditure up to £1,000 is written off to the P&L account. Can I do the same for tax purposes in respect of capital expenditure, such as for purchase of IT equipment and software?
Right. Well, the starting point for a tax on profits is the profit per the profit and loss account produced according to the relevant FRS or IFRS. But that doesn't apply in the case of capital expenditure versus revenue expenditure. And that's a legal definition of capital expenditure, not, it's capital, it's on the balance sheet, it's revenue, it's in the P&L account. So you have to look strictly to see, is this genuinely capital expenditure? And IT equipment and software, which if it normally has a life of 2 years or more, will be capital. So again, in theory, it should be taken out of P&L account and dealt with under capital allowances. Now, you've got annual investment allowance, you've got super deduction for new plant machinery, so it's probably worth treating it for capital allowances in that respect. You'll get extra relief. It's not going to make any difference if you're within those limits, or you don't want the super deduction. But it's still not right. So no, you should do it properly. You should show it as coming out of P&L, add back to profit, and then treat it as capital allowances.
Perfect. Thank you, Tony. Yeah, really, really solid advice there. Okay, and Val, actually, I'm going to throw the ball right back to you. We've been asked, where should the money received under the coronavirus job retention scheme be recorded in the profit and loss account?
Oh, marvellous. I'm glad somebody's asked that one, actually, because and as part of one of the things that I do when I'm looking at files that being produced by people, it's one of the most common errors that I'm finding within sets of financial statements at the moment. And effectively, the coronavirus job retention scheme money is a grant. And so as a result of it being a grant, it should be shown separately. So what you do is you put the wages charge in gross into the accounts, and then you have within other income the grant that's been received in respect to the coronavirus job retention scheme. It should not be netted off. It should be matched. So, sort of it's one of the grants where what you should be looking at is saying that for every month so if I actually receive the money from my April salary claim, if I receive the money in May and my year end is April, then obviously I should be accruing for that income. Similarly,
really topical question there. Glad we got that one in. Okay, the next question then, I think this is another one for myself. Somebody has asked, or they've said, I'm familiar with Xero as a bookkeeping software, but now you're moving into the accounts production space. So what exactly does this product do, and why should I start using it? Yeah, very fair question. More than happy to answer this one. So I think what we're talking about here is actually Xero Tax. And so if for anybody on the line, if you weren't aware, we actually at Xero have, in the last few years, released Xero Tax. And it is a cloud-based accounts production and tax filing solution that's available at no extra cost to our accounting and bookkeeper partners who are part of the partner program. Now, our vision is essentially to provide our accounting partners with a complete end-to-end compliance solution. And that's one that takes information from right within Xero's bookkeeping product and the software that we all know and love, and helps you to easily produce statutory accounts and eventually to file for all types of tax returns. Now, when we first launched Xero Tax, it was only available for micro entities on FRS 105, but it is now available for FRS 105 and 102.1a, which is really great news. And even better is that we are not stopping there. The plan absolutely is to have complete coverage. And so on our immediate roadmap, we are looking to introduce both partnership and personal tax. So they are on the way very soon. So if you haven't heard of Xero Tax and it's the first time hearing, I would definitely recommend, give it a go. If it can save you time and money, then, why not? So if you're not part of the partner program, just reach out to Xero. And once you're set up with an account manager, they'll definitely be able to help you with all of that.
Can I just ask a further question on that? So you're saying you're going to go on to partnership accounts, but are you going to go on to FRS 102 full accounts, or are you just going to stick at FRS 102.1a?
So I've been told, unfortunately, I don't work as closely with the tax product. No, I'm more than happy for you to ask the question. I can absolutely say that the intention is to have full coverage of anything that is being used right now. We eventually want accountants to be able to use Xero Tax as a one-stop shop for all of their clients. So it definitely is in the roadmap. I can't tell you when it will be, and actually, we may even already be able to support it. I'm just not as sure on the, if it's just the abridged or the full accounts. But I can definitely find out for you and let you know after. So thank you very much, Val. So the next question then, I think this would be a great one for yourself, Tony. Somebody has said, how do the rules on directors' expenses and drawings apply to contractors now treated as inside IR35, where the company's income is subject to PAYE?
Yes, a lot of confusion here. Of salary, the PAYE deductions are all done by the client or one of the or the agency, depending on the chain. And the contractor receives net pay with a P60. So the contractor is an employee of his own or her own company, not an employee of the client. So expenses payments are dealt with as somebody who is receiving remuneration from their company. They can claim the travel expenses that an employee can claim. The company, in theory, will get the deduction for expenses, for the company expenses that would normally be perhaps a benefit in kind. which means the company then has expenditure but no income or no net income if it's only got contractor income, and the contractor's got a benefit on top of their salary. So you really have to break it down, and although it's done as a shortcut through pay as you earn, you have to say no, the company is receiving income, the company is making a payment to the contractor, the company is paying expenses and reimbursing the contractor, the client is reimbursing the contractor, and break it down to its fundamental principles.
Awesome. Yeah, definitely a bit more of a complicated scenario.
It is complicated, but a lot of contractors are not understanding how IR35 works, either because they weren't in IR35 before, or they thought they weren't in IR35 and didn't operate it. I think clients are probably now saying, we're going to play safe. If there's the slightest doubt, we're going to put you in IR35. We'll deduct the tax. We budget for the cost. Sorry, chum, it's your problem. You're going to get less money, but we can't take the risk of being hit with a big bill in 1, 2, 3, 4 years' time by HMRC. When they turn up and say, "Oh, you've got 100 contractors you should have deducted pay as you earn from. Here's our demand for hundreds of thousands of pounds."
Definitely, yeah. Absolutely. Right. Well, I think the next question then I've just seen come through. This one looks great for you, Val. Somebody said, "What should I do if I think the business has overclaimed the CJRS?"
That's really quite interesting and very topical at the moment in terms of what it is that we've got. I think that there is, you can see stuff in both the national press and also within the financial press where they're talking quite heavily about people either making mistakes in terms of claims that they've made, or alternatively committing fraud because they've actually claim for stuff that they're not entitled to, which is not just in terms of the coronavirus job retention scheme, but it's also in terms of things like the bounce back loans and the CBILS loans, where sometimes people have stretched the truth a little bit in terms of what it is that they're saying, or alternatively are using the money for purposes that it wasn't set out for. So which actually I could say in terms of those ones, it's worthwhile mentioning this bit would be that, for example, if you look at the bounce back loans, if you're dealing with owner managed companies that might be IR35 or might have been in the past, that what they've done is they've taken a salary, a low salary plus dividends. Then if they were using the bounce back money to support the salary payments, then that's fine. That's within the terms of it. But if they're using it to pay dividends, that's not fine, because it's supposed to be for business purposes, and the dividends wouldn't be seen as being for business purposes. So, sort of maybe a stronger argument sometimes for some of those companies to encourage them to take more in the way of salary rather than dividends in terms of what they're doing. If when you're doing the work, and we are still, like I coin a phrase from years ago in terms of auditing, we are still seen as being watchdogs, not bloodhounds. So we're not there to try and root out fraud, but we are supposed to use our professional judgments and to keep our eyes open when we're looking at it. So if what you're doing is you're looking at a company and they've claimed for the coronavirus job retention scheme, they've for maybe 90% of their staff, but you've only seen a 5% reduction in their income, you might actually ask a question: how have they managed to lately? You've been able to actually to furlough people part-time, if you like, in terms of what it is that you're doing. And so in some respects, that makes it more complicated for us than it was in the early days, where it was, if they're furloughed, they're not allowed to do any work at all. And I think some people might have, they might have stretched it a little bit in terms of what they've done, but there are instances that are being reported of businesses where they have claimed it and then they've made the staff work full-time. And so where that happens, where you have a suspicion that that's happened, then that brings in your money laundering responsibilities, because it would be reportable. So, you can't just turn a blind eye to it. If you've got a suspicion, you would need to make a report. So a bit of a long-winded answer, but it's going to be very big for, I think, a lot of firms and accountants in this next 12 months. Yeah.
Definitely. No, I think, again, another really topical question. I'm glad that one's come up. So yeah, thank you for that. Okay, Tony, I think I'll ask you the next one. We've got a question coming through with a specific scenario, and somebody has said, I have a small business client who is always having trouble with cash flow because of carrying too much stock, late invoicing, and not chasing customers for payment. Should I suggest that they use the cash basis instead?
They should certainly look at it, and I would have thought the answer probably is yes, if they're within the limits, because with the cash basis, you don't worry about your accounting profit. You pay tax on the difference between your receipts and your expenses. But I mean, as every accountant will advise their businesses, don't treat your cash profit as your profit, because there's a creditor lurking somewhere that's going to drop a hefty invoice on you. Whether it's your annual subscription to a professional body or some other annual charge you pay, insurance or something that you've forgotten about. But no, in terms of someone with cash flow problems, then yes, pay your tax, use the cash base. It's totally easy to use. When you switch, you have to make sure you don't double count. So there's provision for not double counting income that you've accrued and then tax when you receive it. And likewise, you can't claim an accrued expense in 1 year and then claim a deduction when you pay it the next year as well. They're not that generous at HMRC. But apart from the switch over, just your net cash in, that's what you pay tax on.
So in some respects, that's a lot easier as well if you've got companies that do cash accounting for VAT purposes, isn't it?
Yeah, it's only available for individuals, not for
right.
Okay. Not for limited companies.
Okay.
It's only available income tax. But yes, if you've got a sole trader or a small business, then yes, because you just have to record your receipts and your payments.
Cool.
As I say, you need to keep an idea of where your creditors are doing, and otherwise there'll be a queue lining up down the street. But in terms of finance, yeah, you're just paying tax on the money in the bank. So
what's the limit? You said there's a limit.
Sorry. It's in my talk. It's 150,000 turnover to start with.
Right, cool.
If your turnover goes up to 300,000, you can stay in.
Oh. So it's just qualifying initially. Yeah.
But it's 100, and then there's problems if it stays if it goes up beyond that. But yes, initially you've got to have a turnover below 150,000.
Thank you.
Awesome.
And you just tick a box on the tax return, make your adjustments on the tax return for the switch over, and just show your profit.
Awesome. Perfect.
Or both.
Or both, because if you are you buying a car or are you leasing a car? As far as tax law is concerned, if you buy a car on hire purchase, for want of a better expression, whereby at the end of the contract you have an option to purchase the vehicle outright, then that qualifies for capital allowances, and you get the relevant rate of capital allowance according to the CO emissions of the car. If you have a similar agreement without an option to purchase at the end of the contract, then you're renting the car, and whatever goes through the P&L account for the rental payments, leasing payments, you have to reduce by 15%, disallow 15%, unless the car is low emissions, which I think is now 50, whatever it is per whatever. But yeah, so you have to, and I'm afraid the only way around it is to look at the lease. And I know it's a pain, because I can remember having to get people to look at the lease, and the client says, "Why do you want to see all my car leases?" Well, because some are hire purchase or contract, whatever it's called, and some are straightforward rentals. And don't worry about what my accounting team have done, because they've bunged it all in fixed assets, whatever.
Awesome. Hey, perfect. That's spot on. Okay, I think Val, back over to you for the next one. Nice short and sweet question here. Somebody's just asked, how do I treat rent deferrals in the accounts?
Okay, this is a this is a really interesting one, because to a certain extent what we have now, it's one of the only areas where we've had an update in that interim period between the triennial reviews of both FRS 105 and FRS 102, where what they've done is they've actually looked at the situation specifically for what you could do in respect of rent deferrals in the COVID era, if that makes sense. And then what we have to do in terms of actually looking at it is that we need to consider two different things. So we can have rent deferrals, or we can have rent forgiveness of rent, if that makes sense to you. And the treatment that you'd have within the accounts is slightly different. So if all that they've done is they've just said to you to ease your cash flow over this 12-month period, we're allowing you to have 3 months or 6 months rent deferral, so you don't have to make the payments, but you still owe the money. So similar to what you've had with mortgages, you know, or if people have actually gone for that on a personal level in terms of going for the deferral, you still owe the money, the interest still accrues. But what they do is that once you come to the end of the period, they spread that over the remaining term of your mortgage or the loan in terms of your payments. So if it's a deferral, a strict deferral, then the issue would be that your charge within the accounts would still be the same, because we were still due to pay the money. It's just that the landlord has said to us, actually, you don't need to pay it now, you can pay that later. And if you had then, at the end of the deferral period, if you had a remaining, say, 5 years of the lease to go, and they were spreading your 6 months of deferral over that 5-year period, then it would increase the amount that you were paying each month, but the charge within each accounting period would be the same. The impact would only be in terms of you determining how much of that 6 months worth of rent deferral was put in a short-term creditor and how much was put in a long-term creditor. So how much was due within the next 12 months and how much was due after more than 12 months. Your operating lease commitments would still be the same, because the amount that you're charging to the P&L each year would be the same. That's a deferral. The other question that people ask in terms of this is, what about rent that's been forgiven? And what we would normally do with that, induced rent charge, and you take the full impact of that within the current accounting period rather than spreading it over the period of the lease. So I hope that makes sense to you. So a deferral, no impact on the P&L in terms of the charge. It's just on your liabilities in terms of what you do. Forgiveness of rent in the COVID period, in accordance with FRS 105 and FRS 102, what you do within those ones is you just actually reduce the rent charge, similar to what you're doing with rates charges at the moment, where you've got businesses that have got a lower rates charge to help them through the period.
Perfect. Yeah, really clear. Thank you, Val. Okay, the next one I'm actually going to put to the both of you, whoever wants to take this one. We've just had a question come through from Stephen on the line, just asking to either of you, do you predict any changes to UK GAAP after Brexit and possibly more divergence from IFRS? Up to you if anybody wants to say. I know it's tricky.
I will say it. No, I don't think so. That's my personal opinion in terms of where it is that I'm looking at it, because I think that, you know, even with Brexit, the aim is still that we want to be able to harmonise and to make it as simple as possible to trade with Europe. And so as a result of that, I think that for some of the things that might happen, there's a possibility that we'll actually slow the introduction of things. So we won't necessarily go for exactly what it is that they're doing. But I still believe that what will happen is that we will follow for both auditing and for financial reporting, we will follow very closely the standards that they've got within Europe. So, you know, that's my view. I don't know what Tony thinks.
Well, I mean, I just my gut. I mean, IFRS is more than just Europe. So I think definitely we'll stick to IFRS. Yeah. I can imagine if Europe came up with some really weird and wonderful change that affected an FRS that wasn't accepted under IFRS. I can't believe they would, but if that happened, I could see the UK saying, no, we're not going to follow it just because you've got it. But as Europe's got to keep close to IFRS anyway. Otherwise, we're just going to have, umpteen different standards depending on which country you're dealing with. And business, large business now, which is what we're talking about, is so international. You've got to have common accounting.
Yeah, no, I agree with that entirely. What I would, though, perhaps give you is an example that if you look at the anti-money laundering side, where we have an harmonisation in terms of what it is that we do, there is a sixth directive that was brought in Europe that the UK bowed out of. So, but what we did was we bowed out of it on the basis that we felt that our current regulations covered adequately everything that was required by the sixth directive. So that was done very, very early on in the process. So there might be things that are like that, but I think that we'll always keep a very close eye on it. And I don't think that we're ever going to be as divergent. Tony will remember, because he would have perhaps been studying for his chartered exams when we still had, sort of pre-Companies Act 1985, where, sort of we had, and it was in Companies Act 1985 that really we started the whole process of the harmonisation, wasn't it, with Europe? And I really can't see us ever. It didn't. No, we had some new ones in. So when I was doing it, I think we had a 76 Act, an 80 Act, and an 81, and the 85 Act was a consolidating piece of legislation.
Yeah, so there was a 70. Yeah. No, I remember the 76 Act. I'd have had to take into account.
And the 1948 Act then, because that was the previous from 85. That was the previous consolidating piece.
57, and there were changes in 76. I couldn't tell you what they were.
Yeah.
We had statements of standard accounting practice.
Yeah.
SAPs.
SAPs, absolutely. And there was probably only about 10 of them, I would imagine.
Accounting was dead simple and dead logical.
Yeah. It was. And the SAPs, when we used to have the SAPs, they were only about 4 pages long, weren't they?
Oh, yeah.
In terms of the way that they were. It was a lot easier than what we have now.
I've always been convinced that once the Accounting Standard Boards made a few necessary changes, they decided that in order to keep their jobs going, they had to keep thinking up new ways of doing things. So every 5 years or so, they redesigned a set of accounts.
Yeah, absolutely.
I had inflation accounting at one point.
Yes, I can remember that.
By the time that came in, Maggie Thatcher had got rid of inflation, so nobody ever used it.
No. Yeah, but they tried it again, didn't they? Because I can remember that when I was doing mine, I think there were 2 that were dealing with inflation within the accounts, but neither of them had ever come to anything. They were just there.
You only had to use it in certain circumstances. You say that inflation then went the high inflation we were having in the 80s just disappeared, and nobody ever needed it. No.
Yeah.
Well. Yeah, I mean, my takeaway from that is that both of your memory is on point. I'm so jealous.
Looking ahead, I don't see Brexit will make any difference.
No,
perfect.
Ditto.
Awesome. Thanks, guys. Okay, next question that we've had come through then. I think this one's great for you, Tony. Somebody said, clients have just taken over the lease of a bankrupt restaurant, including fixtures, fittings, and some equipment. Now, they're going to refurbish the premises and open a new restaurant and are hoping for a contribution from the landlord. What tax relief can they claim on all the costs that they incur prior to opening?
They can claim a lot, but they have to look at the costs very carefully. This is a detailed examination of expenditure, and it may, if they're using external builders or restaurant shop fitters, whatever, has to get a breakdown of the work they're doing. Now, what we're going to have at the moment, we're going to have super deduction on a lot of the cost, on any new plant and equipment being purchased. We're going to have annual investment allowance on the integral features, like some of the plumbing and electrical work, the air conditioning. We're going to have some repairs probably to the inside that just needs tarting up a bit, where they're doing some repairs and decorating. And that's probably the things they need to look at. So look at new plant, which they'll get super deduction on, integral features, which they'll get up to the limit, which is still 2 million, annual investment allowance on, and then repairs, where it's not a repair that's part of the construction of refurbishment, where they're just repairing part of the premises, where they'll get an income relief against taxable profits.
Awesome. Yeah, lots to unpack on that one, but perfect. Yeah, really clear answer.
I would just say though, if they're capitalising some of their repairs, their tax relief is dependent on what's charged to the P&L account, not what goes onto the balance sheet.
Perfect. Okay. Right, on to the next one then. I think, Val, a great one for yourself here. We've got a question that's come through just saying, the directors vote a dividend at the end of the year to clear the DLA. Is this an issue?
Yes. In answer to that, I think that the issue that you have with it is that the Companies Act requires you to disclose details, or requires them to disclose details of advances that have been made to directors. So if what they have is they have a director's loan account that is in credit throughout the year, then there is no issue in terms of that and the disclosure that's needed within the accounts. But if what happens is that they have at some point, so say you had a company where they had a creditor at the beginning of the year in respect of their directors of £30,000, and that during the course of the year they had extracted £5,000 a month, and then in the last month of the year, they'd voted a dividend, which was a legal dividend of £60,000, which still left them with the balance at the end of the year of £30,000. You could argue, or what some people would argue, is that you should only show that just in creditors, that you don't need to put any additional disclosure in terms of that, just to say that it's director's loan account within it. And that's perfectly fine. But in actual fact, if that's what they've done, then after 6 months, their loan accounts are going to have gone overdrawn. So they're going to now have had that. So for the first time, they're just going to be effectively taking out money which is paying off their loan accounts. Then from 6 months in, the £5,000 a month that they're taking are actually advances to directors. And so that means that you'd have to have that separate disclosure of the movements within the account during the period, and you'd have the advances there. And that would still apply if you're doing FRS 105 accounts. And some people, and Tony might correct me in terms of this, some people say to me, well, what does it matter? Because, sort of like, how do they know in terms of what it is? But I think that if the revenue is looking very closely at things, they'll look at what the movements and the postings have been within the accounts. And of course, once Making Tax Digital extends beyond VAT, then they will potentially have more information coming through to them in terms of what the situation is on a regular basis. And so we need to be a little bit more careful that we discipline them. How you get out of it is that if they've got enough distributable reserves, is that you get them to look at voting the dividends throughout the year, so that of course then they've got the dividends that have been elected and then they've paid them, and so it's fine.
Of course, yep. Okay, I think right, so we're at 1:52. We've probably got time for one last question, which I'm going to be pointing to you, Tony, before we wrap up. So last question of the session today. We've got somebody saying, one of my clients insists that they never end up with more than 90% payment of total invoices by the time you take into account bad payers. Before the time you take into account bad payers, disputes, and customers going bust. Can I just make a bad debt provision of 10% in the account to save having to worry about each individual debt?
Well, I don't know about whether you can make it in the accounts from an accounting point of view, but the taxman won't be very happy with it. So I wouldn't if I were you. If we're talking a limited company, then you have specific legislation called loan relationships, and you impair, to use the accounting technology which the taxman adopted, you impair your debt. So if you look at a particular debt and think, I'm not going to get this, I'll impair it and create a loss, and you can put in a provisional write-off part of that debt. but you have to be specific. You have to look at each debt individually. You can't globally impair all your debts on the basis that it swings and roundabouts. If you're not a limited company, you don't have the same legislation, but you have equivalent legislation which does the same job. The good old-fashioned, you can't have general provisions for debts. A debt has to be bad or believed to be bad, and therefore you have to say your stock provisions are fine. If you're showing your stock, I suppose if your stock provision isn't specific, I don't know. If you looked at your whole stock and said, I'd only get X 100,000 for the whole lot, if it works for accounts, it will work for tax on stock. Okay. The point about debts is there's specific legislation about debts for income tax that overrides the accounting treatment, and there's the loan relationship legislation for corporation tax that overrides the accounting treatment.
Awesome. Brilliant. Okay, well, thank you for that, Tony. And actually, I think that takes us right up until the end of our allotted time for questions. So for everybody who joined us today, I hope you really enjoyed that. And yeah, of course, a massive, massive thank you to Val Stewart and Tony Austin for lending us your time and your wisdom for this last hour. I know that I have learned a lot as well. So a massive thank you, even personally, from me. Now, to everybody on the line, don't forget to join the Professional Accountancy online community on LinkedIn. So there you can continue the debate after the live session and be included in exclusive offers for future events like today. Now, a recording of today's live Q&A will be sent out by email within 48 hours. So definitely keep an eye out for that one. If there's anything you missed and want to take a note of, you're going to have the opportunity soon. Now, there is still time to watch the pre-recorded content. Your expiry date will be displayed next to the webinar. And there is still time to buy the complete event, including a recording of this live session, if you haven't already done so. You can just head over to www.profaccountancy.com, all one word, so profaccountancy.com, where you will also find the online exhibition. Now, feedback forms for the event will be sent out when the event closes. So by completing this, that's actually how you will receive your CPD certificate. So definitely keep an eye out for that survey. But apart from that, that is all from me. So from myself personally, thank you all so much for joining. And Tony and Val, thank you so much for joining.
Thank you.
And to all of our attendees, I hope you have a great rest of your day and enjoy the rest of the events that we have on offer. But I'm sure we'll